I enjoy coming to work every day knowing that clients are depending on me to guide them through whatever financial needs they have.
Every client we have is different. And so it's really about finding out what's really the most important thing per client.
With financial planning, everything is interconnected. So a comprehensive plan means that you're taking care of income needs now, income needs in the intermediate term, and income needs long term. We'll do an asset cycle portfolio. We'll do a riskalyze test. We'll do a life insurance audit or a life insurance review.
And so when we build a deep relationship with our clients, then we can take a step back and then we can look at different options to help them specifically get to their goals. One of the things I feel our job is as advisors is to introduce strategies to clients that maybe they did not know that they were out there. But it's our our job to come out and say, have you ever thought about this?
And the planning it's not always about income, but a lot of it is also about the legacy. So the element of family is very important to us, and it's important to our clients.
Hello, my name is Steve Jablonski, and I'm hosting Financially Speaking with Jeff Bush. We have, again, another exciting topic that really encompasses all people, and everybody owns it, whether they want or not, and it's insurance. So with that said, Jeff?
Yeah, insurance. Well, hello, Steve. Welcome to the show. Here we are again, Financially Speaking, here in our wonderful facility in Pottstown, high atop the Security Trust building. And of course, you know, Steve, you and I have been doing this show for a long time. Financially Speaking has now been on the air for 10 years. We're going on our 11th season here on PCTV. So it's exciting to keep bringing the message out to the masses. And today we're going to talk about a topic that's, you know, sometimes overlooked in the course of financial planning, but it's really, really important. And of course, it's a lot of what we do. Insurance is so important that we've identified it as one of the pillars of our planning. So,
and even though insurance goes way, way back, I think it first got more popular in the mid-1600s when Edward Lloyd in London there started the insurance program of insuring the ships coming across to America.
Yeah, everybody's heard of Lloyd's of London. But really, Steve, you know, insurance is, in its most basic form, it's all about transferring risk, right? Like when you buy insurance, and we're going to talk about the different types of insurance, but basically what you're doing is you're transferring risk. You're transferring risk from you to the insurance company, and they're covering some type of risk, whether it's life insurance, disability insurance, long-term care, health, your car, et cetera, your home.
Yeah, and the first one we can start with, and is really health insurance, and as you said, they're transferring risk.
Yeah, so health insurance is, that's really a big one, and it's health insurance, is really it can be expensive, and it can be an expensive part of one's budget. And of course, if you have a job, oftentimes you're covered with health insurance. If you reach a certain age, 65, you become covered under Medicare, which is the government's version of health insurance, and then you have all the supplements that come along with Medicare, the Part A, the Part A, the Part B, the Part C, the various supplements.
In people's health insurance, there's a couple terms that are broadly used. There's the deductible and then copay.
Yeah, so the deductible would be, that's the amount that you have to cover yourself before the insurance kicks in. So if you have, like, let's say you have a deductible of $1,000, well, the first $1,000 of expense that you incur in any given year, you're going to be out of pocket. And when we say out of pocket, that means you're covering that yourself.
Yeah.
You're self-insuring, if you will, for that first those first dollars, and then the insurance kicks in after that. And generally speaking, the higher the deductible, the cheaper the insurance is going to be, because you're covering more of the cost yourself. And then the copay is the portion that you're going to pay once you've met the deductible. So if you have a 20% copay, that means the insurance company pays 80% and you pay 20%. These are all measures to try to keep the cost down.
Sure.
Right? So, deductibles, copays, these are all things that keep the cost of health insurance down, because health insurance can be very, very expensive.
And there's something that's become quite popular, are HSAs.
Yeah, so the HSA is the health savings account, and that's when you pair that with like a high deductible plan, then you use these health savings accounts to pay for any out-of-pocket expense that you have, whether it's your deductible, whether it's your copay, or whether it's things that your insurance doesn't cover, right? So let's say your insurance doesn't cover eye exams, as an example, or certain, medication. Then you can use your health savings account to pay for that. And the real benefit of the health savings account is that you get a tax deduction when you put money into your health savings account. So if you're putting, and you can do this right through your paycheck, through payroll deduction, if your employer offers it, you just put money into the health savings account, it comes right out of your paycheck, and it's done on a pre-tax basis, meaning that the dollars that you don't spend, you can, or I should say, the dollars that you put in the health savings account are tax deductible. And then the dollars that you don't spend in any one given year can be then rolled over to the next.
Can be rolled over.
Can be rolled over to the next year. So that's the other benefit of that is that you can accumulate dollars in that account. So it's a pretty neat plan.
And I know I've worked with clients that they've continuously saved and saved and saved in the HSA, and when they retire, they have a decent amount of money in there as a supplemental because of the question mark of healthcare.
Yeah. Yeah, it's a good strategy, because you can you can accumulate dollars, and that's one of the big unknowns in retirement is you don't know what these out-of-pocket expenses are going to be, and you've got some good tax-free dollars there to help buffer that expense. And there is a limit on how much you can put into an HSA. And I'm not sure what the limit is right now. It used to be $7,500. I'm not sure if that's still the level or if that's been increased.
Yeah. And then we have everybody, not everybody, but most of us drive a car, and we need insurance for that.
You do need insurance, and in fact, it's a requirement from the state that you do have insurance on your vehicle. And you don't want to be driving around without insurance, but you want on your car. So there are different types of insurances on your car. There's the comprehensive coverage. There's the collision, and then there's the liability. If you get if you get into an accident and it's your fault and you got to pay for somebody else's expenses, but the the collision is, you're in an accident and there's damage done to your car, and your insurance is going to pay for your car to get fixed, right? whether it's your fault or not. But if it's your fault, your insurance pays for it. If it's the other person's fault, then their insurance pays for it. But you got to have the car insurance, and then the aforementioned deductible and copay, come into play here too, with your car insurance, and that controls the cost of the car insurance as well.
Yep. And then we move into homeowners insurance, which is a necessity.
Yeah, so homeowners insurance is, if you and this is also a requirement if you have a mortgage on your house, the people that are holding your mortgage are going to make you insure your house, but you're going to have again a deductible, and could be a copay on the homeowners insurance. But that, if there's any damage done to your home, if there's a fire, they used to call it fire insurance, but now it's much more than just a fire.
Right. Sure.
It could be any kind of damage done to your home. It could be wind damage or
Tree coming down.
a tree coming down on your house, or hail, or any one of a number of things. There could be water damage, et cetera, et cetera. And then that's important, because your house is, for a lot of people, that's your most valuable asset. So you got to insure it. You got to pay to insure the home.
And you can also put an umbrella or insure some contents too.
Yeah, well, that's usually part of the homeowner's insurance, is you insure the contents. But the other thing, Steve, that I think is important to mention here is, not everybody owns a home, but there's renters insurance too. So if you rent an apartment, then you want to insure the contents inside the apartment. So that's considered renter's insurance. So these are all examples of transferring risk, right? You're pulling money, right? So you're paying for your insurance along with everybody else, and it's a pool of money that's going to the insurance company, and the insurance company then is on the hook if something happens. So just think of it as transferring risk, so that you're not carrying all the risk yourself.
And then the next three types of insurance fit into our comprehensive financial plan. So why don't we start out with disability insurance, move on from there.
Yeah, so disability insurance, or what we refer to as DI, that now you're covering your ability to work, right? So if you can no longer function in your job, you can't, let's say you can't work for whatever reason. If let's say you do physical labor and you're no longer able to physically work, then you buy disability insurance to cover you in that event. But it doesn't have to be physical labor. It could be, you could be in a professional setting, right? You could be a doctor or a lawyer. And you need disability insurance, because if you can't perform the daily functions of your job, then you're disabled. The other thing, Steve, I think is important to mention too with disability insurance is there's a portion of Social Security that covers disability insurance. So you can be disabled from a Social Security standpoint and start getting your Social Security benefit before you would otherwise be qualified to get a Social Security benefit. So that's called Social Security disability, or Social Security DI.
And also, when you get your disability insurance from an employer, there's a couple different ways you can get it. One, it could be a pure benefit, and the other one is you pay for it. And a lot of people don't realize that how they're taxed in those two different scenarios.
Yeah, so if you're buying the insurance yourself, right? So then you're paying the premium, right? So then you're getting the benefit, right? So if you're getting that benefit and you're paying for the premium, then that's not a taxable event,
Yep.
or that's not taxable income. Generally speaking,
Yep.
We're
Yep.
talking in generalities here.
Yep.
Of course, you always want to, consult your tax advisor on these things. But if your employer's paying for the premium, then it really becomes a form of compensation. So if that's the case with you getting disability payments, then that's generally taxable, because it would be tax deductible to the employer and then taxable to the employee.
And we've seen the disability environment change. I know when I first got in the industry 20 plus years ago, it was very easy to get own occupation. And now that's kind of drifted away.
Yeah, own OC.
Own OC. Yep.
Yeah, so own OC means that you're covered if you can't perform the functions of your own occupation. So, for example, you're a doctor, so you get own OC. So that means you're disabled because you can no longer be a doctor, right? Let's say you're a surgeon,
Yeah.
right? So you can no longer do surgery. So now you're disabled under own OC. Now, any OC, or I should say the opposite of own OC, would be if you're unable to do any work, right? So let's use the example of the surgeon. Well, you can no longer do surgery, but you can do other things,
Sure.
right? Like, so maybe you can have some sort of a desk job, or you can do other, you can teach, or you
sure.
can do other things. But so if you don't have own OC, there's a line there where you might not be covered if it's not own OC, own occupation, because you can still work. You just can't be a surgeon, right? So that's the difference there. That's what own OC means. So, and generally speaking, if you have an own occupation policy, that's going to be more expensive,
Sure.
because it's going to be easier to qualify for
To
coverage.
claim. Yep, sure. Now let's move on to long-term care. And again, as disability insurance changed, long-term care industries changed greatly over the last 25 years.
Yeah, long-term care is really a big thing right now. In that, as we have an aging population, the population is having an increased demand for these services, these long-term care services. And not only that, Steve, they're becoming more and more expensive. So if you look at these long-term care facilities, whether it is a facility or whether it's, at-home care or remedial care, whatever type of care it is, it's becoming more and more expensive. So long-term care, these long-term care policies, like we have long-term care policies that have been on the books for, over 20 years, over 25 years. And they've become more and more expensive as far as the premium goes, because these insurance companies are paying more and more in claims, right? More and more people are needing long-term care. The expenses have increased astronomically, and this all results in increased expenses to the insurance company. And for the longest time, this is a relatively new type of insurance. Life insurance has been around almost since the beginning of time.
Yeah.
Not quite that long, but it's been around for a long time. Long-term care insurance has not. And when long-term care insurance first came out, they didn't know how to price it.
Yeah.
These insurance companies that were unsure how to price it because they didn't have a lot of experience. Well, now as they're getting experience, and and it hasn't been good experience, they've had to increase the premiums, and these premium increases have been significant. We have clients come to us and they say they're getting increases to like 25% or 40% over a couple of years. And it's like you're on fixed income at that point, and you can't afford these increases in premium. So it's been a real problem. People either drop their coverage, or they're now spending a big significant part of their budget on long-term care insurance.
And then something we've seen to really battle against that is the hybrid with the life.
Yeah. So what we've seen, a lot of insurance companies have come up with these life insurance policies that have long-term care access riders on them. So the long-term care access rider allows you to access the death benefit while you're still alive, but you're alive, but you're in care. You're sick, and you need some type of long-term care. So there's triggers on that policy called activities of daily living. So let's say you can't perform 2 activities of daily living. So what's an activity of daily living? Well, you can't transfer from a bed to a chair. You can't go to the bathroom by yourself. You can't feed yourself. Things like that.
Yep.
So let's say you qualify, or it could be a cognitive impairment. That's a big one. You have some type of dementia or something like that. So what happens is you're getting your death benefit early is really what it comes down to, and it's a way to help offset the cost of long-term care, because we know with life insurance you're going to die eventually, right? We all do, right? So what happens is you're able to get that death benefit early to help pay for long-term care.
And it's also a nice choice to have that, because if needed, you look at the situation at that point in your life, and you may say, you know what, I'm going to spend down some of my money, because if I don't use the long-term care, it passes tax-free to my heirs.
Yeah, of course. The life insurance is tax-free, and for that matter, in most cases, the long-term care benefit that you're getting off this policy is also going to be tax-free. So it's really a good way to leverage some tax-free dollars. And we do this a lot with in some of our estate planning, because we can tell clients that there's money that is going to be carved out for your legacy, and that's important for from a life insurance standpoint. But if you need the care, then it provides some liquidity in the estate to pay for the care. Long-term care is really a big problem, and I think that a lot of people don't realize how big of a risk and how big of a problem it is. But we've got an aging population here in this country. More and more people are living into their 90s, and when you're living into your 90s, the risk of needing long-term care jumps up significantly, and it's really and it's hard to think about and address when you're in your 50s and your 60s. Mm-hmm. It's hard to think about what life's going to be 30 years from now, but we see it in our practice, and especially now that our clients are getting older. As we see clients in their in their age, it's not just the nine. I mean, it's like we see people in their 80s, early to mid 80s even, have need for care. But once you're in your 90s, the risk goes up dramatically.
And when you compare long-term care 20 years ago to today, and someone was paying premiums back then that had no life portion, they hope they never used it. So they hope it was just not that you'd waste premiums, but you are transferring risk. At least today, with the life portion, the premiums they pay, someone will benefit from it.
Yeah, there's going to be a benefit. There's going to be a benefit in the estate. It's either going to help to pay for long-term care expenses, or if it's life insurance, it's going to go to the heirs as far as a tax-free benefit goes.
Yep. Now let's move on to the next one, which is life insurance.
Yeah, well, we just talked a little bit about life insurance and how it fills the need for long-term care, but life insurance really has other uses inside the estate, and that is, when someone dies, there's an economic loss there. So that loss is made up with life insurance that can help do a lot of things. In its most basic form, it helps replace income, right? So, you're a young family, couple of kids, nice big mortgage. You want to insure the breadwinner, because if he or she dies, then, there's the bills still have to be paid. The kids have to be raised. They have, college education, the house, the mortgage, the whole 9 yards. So that, you need life insurance for that. And then, as you get older, you need it to help pay for things that are associated with the estate, whether it's the long-term care that we just talked about, or it's helping to pay for other expenses that are, needed to help settle the estate, whether it's taxes or whether it's there to help buffer, some of the other assets that you have that might not be as liquid. So the life insurance is really there for a lot of reasons, and a lot of it, Steve, a lot of times I like to say it's for tax efficiency, because nowadays you see people that have these big estates that are mostly in IRA accounts that are taxable. So if you have the life insurance, that's going to instantly provide a tax-free benefit.
And with life insurance, to keep it kind of simple, you can pretty much lease it or own it.
Yeah, you can lease it or own it. It's like your car, right? So leasing insurance, I guess the analogy would be like if you're buying term insurance, you're really just owning the term insurance for a short period of time, whatever the length of the term.
Like an apartment sometimes.
Yeah, it's like an apartment. So if you have a 10-year term policy, you have the insurance for 10 years and then it goes away. Whereas if you're owning the insurance, that's some type of a permanent insurance, whether it's whole life or universal life or variable universal life. There's all kinds of different types of permanent insurance, but the permanent insurance is you own it. You have equity in the insurance.
Like a house.
There's cash value. Yeah, it's like owning your house. And I guess as you get older, we've become bigger proponents of owning your insurance, just because the term insurance just doesn't do much good once the term runs out.
Now, to kind of finish up here, Jeff, we have our Wellspring formula, and these insurances fit in where the 7 pillars.
Yeah, so one thing that we've spent a lot of time on over the last couple of years was putting together our process, which we identified as the Wellspring formula. And if you look at the Wellspring formula, and we've touched on a lot of this today, the risk management is really the big one here when it comes to insurance. But it also touches on some of these other pillars like tax planning, legacy planning. This is really how money's going to get passed on to the next generation. Charitable giving. We didn't even touch on that, but a lot of times people are going to be buying these life insurance policies and making charities the beneficiary. So there's really a lot. Insurance really touches on a lot of the pillars that are we've identified as being so important to us, Steve, in our practice. So I'm going to wrap this show up today. This is a good topic, talking about insurance. And if you want more information on insurance, please reach out to us. We're going to put information on contacting our company up on the screen. We'll put our phone number and our email up on the screen. Because if you want more information, if you want to sit down with one of the advisors on our team, we can talk a little bit more about insurance and how it would fit into your financial plan. So with all that being said, Steve, great show today on risk management and insurance, and we're going to sign off. This is Financially Speaking.